Well, for more on this, I'm joined now by Bridget Taylor, a currency trader from Rand Merchant Bank, live from Johannesburg. Thanks very much for speaking to us. So, has the race for cheaper currencies only just begun?
I think it has. I think we've started to see a significant rally. Unfortunately, we're really seeing a lot of concern around this, specifically in the emerging markets. You've seen it in the developed nations, and now you're seeing words used like currency wars, which is a bit of a concern.
And as more governments intervene to weaken their currencies, what sort of global effect is that going to have on the economy?
Well, the interesting thing is that despite the intervention that has been used, I mean, if you look at Brazil, they try to imply some form of tax to stop foreign inflows. You've seen the Japanese intervening, yet we are at pre-intervention levels, and that was merely 2 weeks ago. So the money that's spent in terms of trying to support those currencies ultimately doesn't get the outcome that we're looking for. And that's really the big concern, because it looks as though the huge wall of cash that is moving into these economies is not going to abate for the foreseeable future.
And interestingly, the European Central Bank seems to be bucking the trend somewhat. They actually are looking at tightening monetary policy even further. What are the implications for the euro?
Well, I think that at the moment, it's really a story of dollar weakness. The dollar economy is under severe pressure. I think a lot of the globe was looking for a speedier recovery than what we've seen. And certainly today's non-farm payroll figures will give us some form of impetus around whether or not we're likely to see a further round of QE, which the market has deemed negative for the US, specifically because it really does show us that the US economy is in a lot more trouble than we had initially anticipated.
So what will that ultimately mean for the dollar?
Well, I think that what we're going to do is we've obviously got a dollar holiday on Monday. A lot of guys have gone square ahead of the weekend, also ahead of the uncertainty around the non-farm payroll figures. Unfortunately, the sentiment still remains negative towards the dollar. You're seeing it across the board in terms of the currency plays that we're seeing, and certainly moves back into US treasuries.
And what are the risks for the euro if we see other currencies falling because central banks are pumping more and more money into their economy?
Well, I think that at the moment the demand still remains relatively high from the likes of China. You've seen the German economy continue to have some sustainable growth purely because of the demand that they're seeing out of that region, whereas previously it came out of other regions. So, this talk about concern around the Chinese economy, concern around the Chinese currency, I'm not sure that that's going to be something that is really going to be alleviated for now. I think a lot of concern is that although the Chinese economies continue to do well, their currencies remained relatively weak, which has obviously helped them to bolster their own economic view. The unfortunate thing is that the rest of the globe does not have a situation whereby they're pegged to the US dollar and therefore don't get the benefit of the dollar weakness, whereas the Chinese economy does. So that's where this argument's come out. I think that this is a situation that we're going to find ourselves in for quite some time to come as yield searches persist, as this global growth outlook remains benign. And unfortunately, until we really do start to see sustainable growth and specifically some form of turnaround in the jobs and unemployment sectors, it looks quite dire for the foreseeable future.